So hello guys, welcome back to yet another episode, and in today's video we are at lesson number 10, and we are going to continue with some of these important chart patterns that I already introduced you into. So we have a couple of them that I really want to stress about, so that you also get to understand as you get to move further. But before we get into that, if you're new to this channel, I'll just request you to just go ahead and make sure you hit the subscribe button just below here. Also turn on the notification bell so that every time I have a new episode, you always be the first one to be notified. So the other thing I would like also to request you to do, you can check out my analysis. I've done a couple of analysis on how I get to trade, so that you also get to see what I get to teach you is the real stuff. So right away, let's just get into the chart patterns. In our previous lesson, we looked into two of them, that is four of them. We looked into double top, double bottom, head and shoulder, and inverse head and shoulder. So for today, I want us to get to introduce we get to look into chart patterns, and we get to look into something like we have the rising wedge. So in that analysis that I got to do about GBP, with the rising wedge is whereby you get to see the market is running in between two channels like this. Hope you can get it clear. It gets to move like this, and then you realize for this case, if the market was going up, was going up, it's losing momentum, and it's get to form something like this. So once you get to see the market has touched 3 times like this, you anticipate the 4th time the market is going to break and gets to move downward. So this one is considered to be also a reversal trading pattern. Reversal pattern, that is also considered to be a reversal pattern, meaning whenever you get to see it happen, you anticipate the market is going to move downwards. So it's important for you to note that. So for people who are a bit conservative, right here you get to look for something. You wait for the market to break the trend line, retest, and move downwards. So for this case, we'll be looking for bearish engulfing candle right here. Candle. That's one of the things. Secondly, we are going to look at double tops. We have the double tops. Number 3, you could look for something like the evening star. And of course, the 4th thing to look for here is something we have talked. You can get to look for shooting star. Get to look for shooting star. So if you get to look at these 4 things scenarios here, after it has already broken the trend line, you're going to see a very good entry to go downwards. So how do you anticipate how far the market is going to move? You just measure this distance x here. You get to measure distance x here. So the market gets to move this proportional distance on this other proportional distance. So hopefully with the rising wedge you have understood that. So we have the opposite of the rising wedge, we have the falling wedge. So let's look into that. So we have the falling wedge. So we have the falling wedge. So with the falling wedge is whereby you get to see the market is doing something like this. It was unfolding downwards, but we see some kind of the market is losing momentum going downwards, and as I said, you look for 3 touches on that trend line. The 4th one, we get to anticipate the market is going to break, then retest, and then gets to unfold going upwards. So for this case, you just measure this distance x here. You get to measure this distance x here. So right here, there are the entry reasons for you to get into this trade. 1, you get to look for bullish engulfing candle. 2, you get to look for double bottoms. Double bottoms. And then of course step 3 is whereby you get to look for morning star. And step 4 is whereby you could be looking for a hammer. You get to look for the hammer. So these are the entry reasons that you get to look for after the market has broken the trend line and it has already retested and it's good to go up. So for this case, you'll just place your stop loss here. Your stop loss, that is your SL right there. Your entry will be there, and then your TP will be around there, entry point. Then we have our stop loss here, and our take profit will be right there. So hopefully you're taking note on that, what I'm showing you. It's very, very important for you to pay attention on this. So this is the falling wedge. So apart from the double bottom, the double tops, the head and shoulders, we're also speaking of inverse head and shoulder. This falling wedge is something which really works so many times, and I've been using it for so many times. I've seen this scenario so many times, and it really works magic. So it's important for you to understand that, so that you also get to implement it into the market. So that's for the case of the rising wedge and the falling wedge. So basically, let me just highlight other important chart patterns that you can get also to look into. So we have these, we normally call it the rectangle. These are when the market is somehow consolidating. So we have called chart patterns. We have the rectangle. So with the rectangle, as the word suggests, this is whereby you get to see the market is moving in between a rectangle kind of. These are the trend line. This is trend line 1. So we have trend line 2. So you see the market moving in between two trend lines, and somehow it gets to form something that looks like a rectangle. So as I've already told you earlier, Forex is all about a game of probabilities. So it's important for you to have two scenarios into your mind. First of all, the market could break on the upper side, gets to retest and gets to move up. So here, this is whereby we get to look for entry reasons. So, and for that case, you have to wait for the market to break and retest for those people who are a bit conservative. For people who are aggressive, they just place their orders here. So the minute the market gets to break, they get to activate their trades immediately, and we are already either in profits or in losses. So it's important for you to take note on that. So another important thing is to note that this is scenario 1. This is scenario 1. So we have scenario 2, whereby the market could also break downwards and gets to move downwards. So also here, this is where you can get to look for entry reasons. And for this case, you just measure this distance x here, from here to here. You get to measure distance x right there. You also get to measure distance x here. So we have distance x, you also have distance x. So it's important for you to take note on this. Every time I get to bring these chart patterns into the market as I'm doing my analysis, so that you also get to have that in mind. So basically, that's for the case of our today's video. There is no any other complicated charts that I will be talking about. Hopefully you have already taken note of those ones, so that as you get to move forward, you also have that in mind. So that's it for today, and of course, I'll be looking forward to seeing you in our next episode. One thing I would just request you to just go ahead, make sure you hit the subscribe button, and of course take your time and learn this skill you're getting for free. So that's it for today, and of course I'll be looking forward to seeing you